If you trade Forex using indicators alone, you're not competing with other retail traders. You're competing with institutions that already understand what actually moves currencies. And the reality is that banks don't trade the way most people imagine. They are not sitting there waiting for RSI to hit 30 or 70. They are not watching moving average crossovers hoping for a signal. The biggest players in the Forex market are analyzing economies, tracking capital flows, and positioning themselves around macroeconomic trends. And once you understand how banks actually trade Forex, the entire market starts to make a lot more sense. Most traders imagine institutional trading as something mysterious, maybe secret strategies locked away inside bank trading floors. But the truth is actually simpler and more powerful. Institutional traders focus on one question above all else: where is capital going to flow next? Because currencies move when money moves, and when trillions of dollars move across global markets, exchange rates adjust accordingly. This is where it gets interesting, because institutional traders are not trying to predict every short-term move. They are trying to understand the bigger picture. They want to know which economies are strengthening and which are weakening. They want to know where interest rates are rising and where they are falling. They want to know which countries are attracting investment and which are losing it. These forces shape currency trends over weeks, months, and sometimes years. This is the first major difference between institutional traders and retail traders. Retail traders often think in hours or days. Institutions think in cycles. They analyze monetary policy cycles, economic cycles, and global risk cycles. These cycles create the environment where currency trends develop, and the biggest driver of all is interest rates. Interest rates determine the return investors can earn on capital. When a country offers higher yields, global investors have a reason to hold assets denominated in that currency. That demand pushes the currency higher. When yields fall relative to other countries, capital tends to move elsewhere and the currency weakens. This explains why bond markets are so important in Forex. Institutional traders watch government bond yields constantly. Yield differentials between countries provide clues about future currency moves. If US yields are rising relative to European yields, that often supports the dollar against the euro, not because of a chart pattern, but because investors are reallocating capital. But here's what most traders miss. Institutions care less about today's interest rates and more about where rates are going. Markets move on expectations. If traders expect a central bank to tighten policy, capital often moves before the first rate increase even happens. The anticipation drives the market. And this explains why sometimes currencies fall even when interest rates rise. The market may have already priced in the increase. If expectations shift towards slower tightening or future cuts, the currency can weaken even after a rate hike. Without understanding expectations, price action can seem confusing. With macro context, it becomes logical, and this is what institutional traders do every day. They track economic data, inflation numbers, employment reports, growth indicators, manufacturing surveys, consumer activity, not because individual data releases matter on their own, but because together they form a picture of economic momentum. When inflation rises persistently, central banks often tighten policy. When growth slows, central banks may ease. These policy shifts influence capital flows, and capital flows drive currencies. This is also why central banks are so important. Institutional traders listen carefully to central bank communication. Every speech, every statement, every press conference can shift expectations. Traders analyze tone, language, and guidance for clues about future policy. Small changes in expectations can trigger large moves in currency markets. And this is the part most traders never see. Institutional trading is not about certainty, it's about probabilities. Traders constantly update their views as new data arrives. If conditions change, positioning changes. The process is dynamic. This is very different from the retail approach of searching for a fixed strategy that works in all market conditions. Institutional traders understand that markets evolve, strategies must adapt to the macro environment. And once you understand this, another important piece falls into place: capital flows. Large investors allocate money across countries depending on expected returns and risk conditions. Pension funds, asset managers, sovereign wealth funds, these institutions manage enormous portfolios. Even small shifts in allocation can move currency markets significantly. For example, when global growth expectations improve, investors often increase exposure to growth-oriented economies. That can support currencies linked to commodities and trade. When uncertainty rises, investors often reduce risk exposure and shift capital towards safer assets. That tends to support currencies seen as stable and liquid. This is why global risk sentiment plays such a powerful role in Forex. During periods of market stress, safe haven currencies often strengthen simultaneously. During periods of optimism, growth-sensitive currencies tend to rise. These patterns repeat across cycles. Now, this is where the professional framework comes together. Institutional traders combine multiple macro drivers into a coherent view. They look at interest rate expectations, economic momentum, inflation trends, and risk conditions together. No single indicator provides the answer. It's the combination that matters. Professional traders often think in terms of relative strength. Every currency is evaluated against others. If one economy is strengthening while another is weakening, that divergence can create a sustained trend. These divergences are the foundation of many major currency moves. This is why macro analysis creates consistency. Instead of reacting to short-term noise, traders are aligning with the dominant economic forces. When macro conditions support a currency, pullbacks often become opportunities rather than threats. The underlying trend remains intact until the macro environment changes. And this is exactly the kind of analysis we focus on inside MacroDrivers. The platform tracks the macro forces institutional traders monitor: currency strength across economies, shifts in macro trends, and changes in the global risk environment. Instead of trying to piece together information from dozens of disconnected sources, the framework presents the bigger picture in a structured way. What's interesting is that when traders begin using macro analysis consistently, their entire perspective shifts. Markets feel less chaotic, moves make more sense, trends become easier to identify. Trading becomes less about guessing and more about understanding. Charts still matter, but their role changes. Instead of trying to predict the future from price patterns alone, traders use charts to refine entries and manage risk within a macro framework. The macro view provides direction, technical analysis provides timing. This alignment is where professional trading lives. That's not about predicting every move, it's about positioning alongside the strongest forces in the market. And once you understand how banks actually trade Forex, it's hard to go back to indicator-based trading. You start seeing the market differently. Instead of reacting to candles, you're thinking about interest rates, growth expectations, and capital flows. You're thinking about the forces shaping the global economy. Forex becomes less mysterious and more logical. Trends stop looking random. Moves start making sense. And if you want to trade Forex the way professionals do, you need a structured way to track the macro environment. That's exactly why MacroDrivers was built. It tracks currency strength, macro trends, and global risk conditions in a way that reflects how institutional traders analyze markets. Because the real edge in Forex doesn't come from finding a better indicator. It comes from understanding what actually moves currencies. And once you understand that, you're no longer trading blindly. You're trading with the forces that drive the market. They